Russia obviously has no US dollars, and they got out of US debt, years ago, 5 years ago. So for some countries, you need to be significantly below basically half your assets in the dollar. The World Gold Council just did a survey of central banks, you probably saw it, asking what they would be doing, and a significant majority said that they would be increasing their gold over the next 12 months. If you predict a price, don't predict a time.
Yeah.
And you tell me a time, so I'm not going to be...
Okay.
I definitely think we're going to be higher. That's a simple one.
For most of modern finance, gold has lived on the periphery of mainstream investment strategy, often dismissed as dead weight in an equity and bond-driven world. But at key moments, it surges back into focus, and this week could be one of those turning points. The current gold bull market is being propelled by multiple converging factors, creating what many analysts describe as a perfect storm for precious metals appreciation. At the start of this century, the US dollar held an extraordinary 75% share of global central bank reserves. Today, that number is closer to 47%. Renowned financial expert AdrianDay warns, this accelerated decline is prudent. AdrianDay predicts that if gold hits $5,000 per ounce, the real story will be in the mining stocks. Technical analysts have noted that the producer-to-gold ratio has broken out from a multi-year consolidation pattern, potentially signaling an extended period of outperformance. These technical developments often precede multi-year sector trends. Central banks are not just buying gold, they're stacking it. AdrianDay stresses that this isn't a random trend, but a dominant theme, driven by economic shifts, geopolitical realignment, and the recognition of gold as a primary asset under Basel III. What if the gold rally you're seeing is just the warm-up? The major producers could at least double as a flood of new investors enters the sector. If current accumulation rates continue, central banks could add thousands more tons to global reserves over the next 5 years, further strengthening gold's position in the international monetary system. Most U.S. investors are still on the sidelines. The major gold mining ETF, GDX, saw massive outflows for most of the year. This is proof that the ordinary investor is only just beginning to pay attention. Before we dive into AdrianDay's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
When you look at the dominance of the dollar in central bank reserves, let's say at the beginning of this century, we were at like 75, 78, almost 80% of foreign reserve assets of all central banks was the dollar.
Yep.
By foreign, we mean if I'm the Bank of England, we're not counting pounds.
Yeah.
So everything else I hold. Well, that is extraordinary concentration. Forget whether it's the dollar or gold or Trump or forget all of that stuff. That is just extraordinary concentration to have 80% of your reserve assets in one currency, in one asset. If I did that in my fund, the SSC would be all over me. And again, I know we mentioned this I'm sure we mentioned this in March. This is not something that just started this year.
Yeah.
With the current president. This has been a trend that's been going on for a long time. So we went from, 75, let's just say 75% of foreign reserve assets in the year 1999. 5 years ago, probably 65%. Well, for institutions like central banks that are so slow moving typically, that is a huge decline, especially when during those years, they were actually earning increased number of dollars. So to reduce it was pretty astonishing. And then of course, what were we down to when Trump came in? We were at the end of last year, we were probably down to 55%.
Yeah, I think I saw a figure recently. I think it was around 52%, something like that. Yeah.
Yeah, the last number I saw was actually 47%, and it came from the ECB. But I don't know.
I mean, that's crazy though.
I don't know if you can trust those people.
Yeah.
Foreigners, French as well. But I'm saying but you can see how it's accelerated, but to go from 75 to 65, 65 to 55, and then from 55, as you say, to 52 a few months ago, now to 47.5%, that's a dramatic shift. But to me, it's, even if you take away the weaponization of the dollar, which again has predated the current administration, it's been going on for a long time, but even if you take that away, it just is prudent to diversify, and that's just added the extra impetus. Now, when does it stop? That's a big question. I think central banks are still the dominant, so let's start there. Now, obviously, if you've got 47% of your assets in the dollar, and obviously it's more for some and lower for others, but if you've got on average less than half, well, you know, the urgency is not as much as it was when you had 75%. But if the weaponization of a dollar is something that really concerns you, what's too much? It could be zero is the right number. If you're really worried about them stealing your assets. You know, Russia obviously has no US dollars, and they got out of US debt, you know, years ago, 5 years ago. So for some countries, you need to be significantly below basically half your assets in the dollar. The World Gold Council just did a survey of central banks, you probably saw it, asking what they would be doing, and a significant majority said that they would be increasing their gold over the next 12 months. And I don't think was there anyone on that list that said they expected to reduce them?
Well, I mean, why would you?
So I do think the central banks are going to continue to be buyers. We're clearly now, with the economic shift and with the geopolitical shift, you've got added impetus, which is becoming apparent to people, right? That's the thing, is not whether people like you and I and the intelligent people that it is your audience know about something. The important thing is it a dominant theme?
Yeah.
And I think that the shift in assets, global reserve assets, has become a dominant theme now that investors are paying attention to and wealthy people are paying attention to. And of course, it's not just for central banks, as we mentioned, but it's for Basel III, meaning that gold is a primary asset, you know. So there's a lot of things that are just bringing gold back into a role in the world's monetary system. Let's say gold goes to 4,500. Well, at that price, the gold stocks are going to be massively higher than they are right now. Yeah. Because apart from the increase in the valuation and everything else, that sort of price is just going to get more and more investors interested
the cash
in
flow
the
coming
sector.
out of these companies at that price as
So
well.
you see gold at 45 to 5,000, and you're going to see all the seniors are going to be easily double where they are now. I still think the senior stocks typically, not necessarily every single one of them, but the senior stocks typically are still good values with a lot of, and we're just talking stock price, not company, but stock price appreciation ahead of them. And I say that for two reasons. One is, even though the gold stocks have moved up significantly this year, the US investor, the ordinary investor, you know, the dentist in Oklahoma, or the registered investment advisor that knows nothing about it but is saying, I think we ought to have 2% in gold, or he's getting calls from clients. Yeah. These people have only just turned towards gold. And you can see that very, very clearly in the flows into the GDX and the GDXJ. You know, until the last week of August, right? So all the way up to the middle of August, third week of August, you had massive and continuing outflows from the GDX. I mean, just think about that for a second. The gold stocks are up 50, 60, 70%. Gold's at pretty much new all-time highs. The world's falling apart. But the GDX is seeing massive outflows. So as of last week, when I left the office, I don't know about today, but as of last week, you'd had 2 weeks of inflows into the GDX, amounting to about 300 million. And year to date, you've still lost $3.5 billion. Year to date, you've lost $3.5 billion in outflows from the GDX, which, when you think about it, is just mind-boggling.
It is, yeah.
And so, again, I take that as an indication that the ordinary investor who's not a gold bug is only just turning towards gold. Now, 1 week, 2 weeks doesn't, one swallow doesn't make a spring or summer, right? Yeah. But it's certainly a change in direction, and a significant change in direction. So that's number one. Oh, and sorry, when the dentist in Oklahoma calls his registered investment advisor who knows nothing about gold and says, I think we should have some exposure to gold, what does the guy do? Well, he doesn't buy Ajax Exploration.
Yeah, he buys Barrick or Newmont or
he buys
the
Barrick
GDX.
Or Newmont or GDX, yeah. And so I think the stocks are still going to continue to get inflows. We haven't reached a point where everyone's invested and now they're buying more, and the more is going down market.
AdrianDay emphasizes that North American investors are finally joining the gold rally, but they're not the ones who started it. For years, central banks and Chinese investors have been accumulating physical gold to escape the potential weaponization of the US dollar. Now, with slowing jobs data, falling rates, and a softer dollar, the conditions they've been waiting for have finally aligned, and the mainstream narrative is shifting in gold's favor. Financial analysts project that central banks may eventually transition from conventional interest rate adjustments to more substantial quantitative easing programs as economic pressures intensify. Historical data demonstrates a strong correlation between expansionary monetary policies and expected record gold prices in the coming years. Gold doesn't usually spike on short-term conflicts. AdrianDay says the world is shifting toward a bipolar system, where conflicts in Europe, the Middle East, China, and US deficits are eroding American dominance. The gold rally you're seeing isn't a reaction to a single headline. It's a long-term response to the erosion of an entire world order. Let's get back to the interview.
A couple of things there, if I may. First of all, when you talk about tariffs, and I think you were alluding to the uncertainty this year since Trump came in office. I think we must realize that the gold move and the lack of interest from North America, that's something that's been going on for the last couple of years. So it's not just something that's brand new since the uncertainty with Trump. I think it relates. It's not totally illogical, because I think it relates mostly to who's buying and why they're buying. Central banks, as we know, are buying to diversify their assets away from the dollar in the face of dollar weaponization. And if that's who you are and that's your motive, you might just buy a tiny bit of silver. But basically, you're going to buy gold bullion. You're not going to buy gold stocks. And the same goes as if you're a non-official Chinese investor. You want bullion if you're trying to protect yourself against a possible devaluation of a yuan, and you're going to want gold bullion. You're not going to want, Newmont, let alone Ajax exploration. And so it's not illogical that when you think of who's been buying and the reasons they've been buying, it's not illogical that they're buying gold bullion and not buying stocks. When do North Americans typically get interested in gold assets? It's when the economy is conducive to gold assets, which means a weaker economy, low and declining interest rates, high and rising inflation, and a declining dollar. US dollar. And when you look at it, until really the last couple of months, other than the dollar, which obviously had a big drop this year, but even going on a tangent, even with the dollar, if you look back 5 years, it's still high. But forget the dollar for a second. But the narrative on the economy, on interest rates, on inflation, was simply not conducive to gold investments. But now, and I talk about the narrative because I thought the economy was weaker than the headlines would suggest. But, it's not what I think. It's what most people think. But now that narrative is definitely changing. I mean, with the jobs numbers we've had now, new jobs and continuing claims and new claims, with the whole jobs reports we've had for the last, 2 months, even the biggest bull on the economy has to see the growth is slowing at the minimum. And now, of course, the Fed is almost certainly going to cut rates. Is it next week? 2 weeks?
I think it's September 16th.
So the Fed is cutting rates. And you look at inflation, it's not running away, but it's inching up. You look at the producer price numbers as well as the CPI numbers, and they're inching up. And so the narrative, and the dollar's had a very mediocre bounce. I mean, from when you have a first half decline that is the largest first half decline since 1973, and the bounce they had in the middle of July, that's the biggest you can manage. That's not a good signal. So I think the narrative on all of those economic factors is changing to an economy that is more conducive towards North Americans being invested. And that's the way, that's my framework that I'm looking at this. And then, I'm sorry, you did ask, or you did mention geopolitical. I think a lot depends what we mean by geopolitical. If we typically, if you go back over 50 years, I've done studies, a little pretentious, but I've done
some research
on this. You go back over 50 years and you look at geopolitical events, and of course, in retrospect, we know what was important, what wasn't important. But at the time, you don't know. Remember the bombings on the Spanish Tube and the London bus bombing. There was a lot of concern about whether you were going to get a whole series of these. Yeah. Anyway, my point is, if you look back at geopolitical events, and most of those will be wars or near wars or terrorism, typically the impact on gold is very, very short-lived. If you look at geopolitical events in terms of wars and terrorism, I don't think that has a huge lasting impact on the price of gold. Yeah. I mean, typically Russia's a good example of a Russian invasion of Ukraine, where gold moved up ahead quite dramatically as they massed the troops on the border and everything else. The day the troops went in was the peak. Yeah. And 6 weeks later, gold was back to where it was 6 weeks before the invasion. And you look back, even if you look back at, say, 9/11, which of course was the dawn of the gold bull market of the 2000s, but gold had a spike on 9/11, and then it sort of retreated. There were factors there with the stock market being closed, of course. So if people wanted liquidity, they couldn't get it from stocks.
From stocks, so they could buy gold.
So there were other factors. But of course, gold went up afterwards. But I'm arguing it wasn't because of 9/11 or the fallout from 9/11, or the invasion of Iraq is another example. These things have all been short-lived. But, and here's the Kim Kardashian, the big but. You're absolutely right. So that's when you're talking about geopolitical in terms of wars and terrorism. But when you're looking at changes in really the whole global monetary system, because that's what you're talking about going back to Sparta and Athens, it's who's the dominant power. Yeah, I think more and more people are realizing that whether it comes slowly or rapidly, and I always think people are expecting major changes like that to happen. But to me, it's a little bit like that overused phrase of Hemingway, how do you go bankrupt? Slowly at first, then suddenly. And, that's all at once, sorry. And then that's how I think we're going to see this play out. The US is still the dominant power militarily. It's still the dominant economic power. It's still the dominant political power. And it's still, the US dollar is still the world's major primary reserve current asset and primary trading asset. But when you look at how quickly those areas have been eroded, I think we're moving towards not necessarily where China replaces the US, but people have talked about a bipolar world. This isn't, I'm not the first one to come up with that. And in fact, a lot of the people surrounding the Trump administration, not necessarily in it, but it was in Mirren's paper back in November before the election, the Mar-a-Lago Accord,
yeah.
But it's also Steve Bannon, who's not in the administration, but likes to say that he has influence in the administration. I don't know how true that is. But a lot of people around the administration and think tanks and everything else are talking about, hey, a bipolar world is fine.
Ongoing central bank purchases provide structural support for the gold market, representing a fundamental shift in institutional attitudes toward monetary metals. This trend appears likely to continue as monetary authorities diversify reserves away from traditional fiat currencies. The long-term secular bull market in precious metals could drive prices toward the $5,000 level by 2030, though such projections should be viewed as general directional guidance rather than precise targets. Are we witnessing just another cyclical upswing or the beginning of a generational repricing of gold's role in the global financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.